Tom Halverson, great to have you back. Thank you. We wanted to get you today to focus on a subject that's getting a great deal of attention right now. That's this idea of ESG investments. It's a phenomenon that originated in the equity markets, but it's kind of edging its way into debt markets, including commercial lending. We're hoping you'll demystify the subject for us a bit and also talk about its implications for the rural economy here in the U.S.
Good. Well, I'm looking forward to it.
So let's start with a definition of the term and also some historical context. So ESG stands for environmental, social, and governance, and it's the label that has emerged as kind of the most commonly used term for this idea that investment assets get evaluated on societal benefits in addition to financial measures. And maybe we could just start by having you talk about that. Where did this idea come from that an investment should be rated or evaluated using anything but a financial return as a measure?
It's a very interesting question, and the fact of the matter is we're all very fortunate to live in the world's most vibrant and competitive market economy, which is predominantly led by a vibrant and competitive private sector, right? And the fact of the matter is, in a private sector-driven market economy like ours, investors can make investment decisions on any criteria they want, right? And traditionally, the definition of what people want to make investment decisions on was the profitability and the economic returns of the companies that they invest in. And therefore, the view has been for a long time that the job of a company is to maximize shareholder returns for the owners of the company. Well, that's not always the case 100% of the time with all of the investors, right? And back when I was in college, for example, in the 1980s, there was a big anti-apartheid movement, and there were a lot of activists who were trying to encourage people to divest from South African companies because they were opposed to apartheid. So they were using their investment decisions and trying to influence investors to change their investor behavior to make it harder for South African companies to raise capital to have an impact on trying to bring apartheid to an end. So this is not a new phenomenon. It's just that the things that people in the economy and in the country and in the world, frankly, care about as investors continues to evolve as you would expect it to. And today, those types of concerns are heavily environmental oriented, for example, and I'm sure that's one of the pieces of ESG that we'll spend some time talking about.
This is a graph from a nonprofit organization in New York that tracks ESG investments. They've grown substantially over the last decade, as you can see here, from $3 trillion back in 2010 to over $17 trillion today. You mentioned the environment earlier. Is that the primary driver, or are there other things happening as well here?
I think that environmental considerations are a substantial portion of this, but not exclusive. Bear in mind that $17 trillion there on the right-hand side compares to the U.S. GDP, which is about $20 trillion. So the amount of invested assets as tracked, at least by this organization, is already very close to equal to the size of the entire U.S. economy's output for 1 year. So this is very substantial. And I think that the trend will bear out that this is continuing to accelerate. A lot of investors, a lot of people in the world and in our country are very concerned about the environment. That drives a lot of this. But there are other factors in social and in governance as well that are also accelerating in interest in the eyes and in the investment decisions of investors.
ESG is an easier thing to understand when it comes to the equity markets, because at the end of the day, what's happening there is that the investor or the asset manager is basically picking stocks that meet their sustainability criteria. It's a more complicated thing when you get into debt markets, and we're hoping you can kind of unpack that a little bit for us. And we'll bring up another chart that shows the U.S. corporate bond market. This is a very substantial, actually the largest source of debt capital for companies, over $7 trillion today. Talk about how ESG is showing up in this area as companies issue bonds out into the marketplace.
Well, if you're a company that has a large need to have debt capital in your capital structure, you obviously want to borrow that money on the best terms possible and have the broadest and deepest investor base that you can possibly get. And as the previous slide showed, the amount of ESG investment capital is increasing, right? And therefore, if you're wanting to maximize your investor base, you want to access that capital pool. So what's happening is that enterprises that have significant, say, for example, greenhouse gas emitting a business profile, right? They are increasingly putting together things that might be referred to, for example, as a sustainability framework and kind of a long-term strategy and plan for how they are going to address the commitments that they might make as a company relative to greenhouse gas emissions or other metrics, right? They can put that framework in place, and then they can go out and do what we might call a green bond issue, where they make some commitments about that that are interesting and attractive to the potential investors. They'll probably be able to attract their legacy investors who are less concerned about ESG matters, who will just buy it on the same bases that they've made their investment decisions in the past, but they might access a whole bunch of new capital with new investors who like the fact that they are buying the bonds of a company that's making sustainability commitments or has made some promulgated some targets about containing their greenhouse gas emissions and things like that. And therefore, for the company, what they're going to end up doing is there may be some impact on price. If there's enough demand from the ESG investor world, they might get a better price and better execution. They'll certainly diversify their investor base. So there are reasons for companies to want to go down the road of creating frameworks and commitments that will attract ESG investment capital.
Just to clarify, when you say get a better price, that means a discount on the interest rate associated with the bond that's being issued, correct?
Either the coupon could be different, or instead of, they could sell it at 101 instead of 100, for example.
That's the corporate bond market, and that is a market that is accessed predominantly by larger enterprises. There's a whole nother universe of companies, smaller and mid-sized companies, that really don't have an easy way to access corporate bonds, and they rely predominantly on commercial loans, and we want to talk about that next here. So a smaller market in the grand scheme of things, $2.5 trillion in commercial loans here in the U.S. versus the $7 trillion on corporate bonds, but a lot of those smaller and mid-sized enterprises are really confined to this area when it comes to debt capital. How are ESG considerations starting to come into conversations that borrowers are having with their banks about new debt that they want to issue?
Well, it's a little bit different in that you're not doing a billion-dollar bond issue slice. The individual bonds get sold to lots and lots and lots of different investors in a diversified pool. In a bank loan, obviously, you might have 1, 2, 3 agents who lead the financing and a syndicate, 5, 10, 15, 20 other banks, but they don't chop it up into small pieces and spread it out to thousands of investors. It's held by a small number of banks directly on their balance sheet. So the question is, what's the motive for those banks to do this? What's the benefit? Well, if you are a consumer products company in the agribusiness space who is already making commitments about your sustainability, or you may have made a net zero by 2040 or 2050 kind of a commitment because that's what your market demands, that's what your customers and consumers demand, and you've already made those kinds of commitments, banks can, may, and already are doing similar things to what I just described from a bond market perspective. It's not as far along, it's not as prevalent as it is in the bond market, but it's moving along quite expeditiously too, where you have a company that says, hey, we're making these commitments, or we're going to make a new commitment as it relates to this part of our business to reduce our carbon footprint or what have you, and they'll put in a loan agreement to say, hey, we'll give you a reduction in the spread on your loan over the index if you meet the following targets that we've put in your loan agreement. right? I mean, there's increasing evidence to indicate that the regulatory structures for the banking sector are taking a keen interest in this, and that there may be regulation, or will certainly be monitoring in this space of the activity of banks as well. So there's motive, and increasing motive in the financial services industry broadly, but in the banking sector in particular, as it relates to moving in these directions.
Let's bring up the final chart here to look at, which is just a follow-on, which shows ESG loans globally broken down by region. This shows kind of a couple things. One is that Europe has been the leader on this, but Asia and North America are kind of catching up in recent years. The other is that the dollars are just not at the same scale yet. It's $200 billion globally in a commercial loan market that's trillions and trillions of dollars. Do you expect, when it comes to ESG lending, the same kind of hockey stick to develop over time that you've seen in the other asset classes, or do you think it's going to be slower and lower?
That's a great question, and you're right. These numbers are demonstrably lower than the preceding charts. One thing I am quite confident of is that it's going to be an upwardly sloping curve, right? The question is it going to be a, upwardly sloping exponential hockey stick type shape? I really can't answer that. I don't really know. I know it's going to be an upwardly sloping curve, and it is the case that the rest of the world has moved further faster than we have here in the United States. But I believe that it will that it will be accelerating, and it won't be accelerating because the government told us to, and it won't be accelerating because the banks are forcing it down the throats of reluctant borrowers. I think the principal driver here is going to be market forces themselves that are acting on companies themselves, particularly companies that have retail and consumer type industries, where their consumer markets are demanding products from companies that make these types of commitments. And if you're a company that's making these types of commitments and changing the way that you run your business anyway, you're going to want your financial partners to give you some benefit for that, give you some credit for that, pardon the pun, and be attentive to that, and help to provide some third-party validation for the progress and the steps that you're making relative to those commitments. So as always, I come back to the point that market forces are the predominant driver of what happens in our market economy. And I think that will be the case here too.
A lot of the rural economy is environmentally intensive, agriculture, rural utilities, et cetera. It just has a heavier environmental footprint than what you might see in other parts of the economy. Is this trend, in your view, a positive for the rural economy, a negative, a mixed bag? What do you think the impacts are going to be for the industries that CoBank finances, for instance?
If you try and fight where the market is going, that's probably not going to be a successful long-term strategy. If you try and work with the market, where the market is evolving, how the market is evolving, in the direction that the market is evolving, and try and make sure that you're a top quartile or top half performer in the industries that you serve, you're likely to be successful in the long run.
Finally, what is CoBank doing specifically right now as it plans to help its customers transition as this trend plays out?
Like many other businesses, like many of our commercial banking competitors, for example, we're trying to get smarter, much faster, figure out how we want to be internally organized and positioned, make sure that we're always a source of knowledge, wisdom, judgment, and experience for our customers as a go-to place to find out what to do, find out what others are doing, and to be a helpful resource for our customers, and to position ourselves, like I just described, to be able to move at the speed of the fastest moving of our customers and at any other speed that is appropriate. We want to be part of the solutions here for our customers, not part of the problem. And that means that we have to be really smart, really flexible, really knowledgeable, and add this type of knowledge, skills, judgment, and experience and capabilities to our products and services and knowledges to benefit our customers as they grapple with what is in fact a rapidly changing marketplace.